Preparing for a Coca-Cola financial analyst interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question, you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to become a financial analyst at Coca-Cola? I am attracted to Coca-Cola because it combines a powerful global brand portfolio with complex financial decisions across markets, channels, currencies, and bottling partners. A financial analyst can influence pricing, marketing, investment, forecasting, and resource allocation rather than simply report historical results. My strengths are structured analysis, clear communication, and attention to detail. I would bring those skills to turn data into practical recommendations while learning how Coca-Cola protects margins and generates sustainable cash flow. While answering, connect your analytical skills to Coca-Cola's global scale, iconic brands, revenue growth challenges, consumer products economics, and the opportunity to support disciplined commercial and operational decisions. Question 2. Walk me through Coca-Cola's 3 financial statements and how they connect. The income statement shows revenue, expenses, and net income over a period. Net income flows into retained earnings and begins the operating section of the cash flow statement. The balance sheet captures assets, liabilities, and equity at a point in time, while changes in working capital explain part of the difference between earnings and cash. Capital expenditures reduce cash and increase fixed assets. Depreciation then lowers earnings without immediately using cash. The statements must reconcile through ending cash and equity. Make sure to cover the income statement, balance sheet, and cash flow statement, including net income, retained earnings, working capital, non-cash expenses, capital expenditure, and the importance of reconciliation. Question 3. How would you analyze Coca-Cola's revenue performance? I would decompose revenue into volume, price, mix, foreign exchange, and portfolio or structural changes. For Coca-Cola, unit case volume and reported net revenue can move differently because pricing, package mix, concentrate sales, bottler arrangements, and currency translation affect results. I would compare actual performance with budget and prior year by operating segment, then investigate whether growth reflects sustainable demand or temporary pricing. Finally, I would assess implications for gross margin, marketing investment, and the full-year forecast. In your answer, talk about revenue growth decomposition, unit case volume, price, mix, geographic performance, channel trends, currency translation, acquisitions, divestitures, and comparison with budget and prior periods. Question 4. What is the difference between concentrate sales and finished product sales in Coca-Cola's business model? Concentrate sales involve providing beverage bases or syrups to bottling partners, while finished product sales generally include the production, packaging, and distribution of ready-to-drink beverages. The mix affects revenue, reported margins, working capital, and the timing of shipments. Coca-Cola's system also relies heavily on independent bottlers, so analysts must distinguish company-level results from system-wide consumption. I would understand which products and markets use each model before interpreting volume, revenue growth, or profitability. Be sure to mention concentrate economics, bottler relationships, finished product revenue, geographic differences, margin implications, timing, and why understanding the business model improves forecasting and variance analysis. Question 5. How would you distinguish volume growth from price and mix growth? Volume growth measures the change in units or cases sold, whereas price and mix growth reflects changes in realized revenue per unit from pricing, package sizes, brands, channels, and product composition. For example, revenue can rise while volume declines if price increases more than demand falls. I would build a bridge from prior period revenue to current revenue, isolate each driver, and test whether the result is consistent with elasticity, promotions, competitive activity, and gross margin performance. While answering, focus on physical volume, realized pricing, package and product mix, revenue bridges, consumer elasticity, promotional activity, and how each driver affects revenue, margin, and forecast assumptions. Question 6. How do foreign exchange movements affect Coca-Cola's financial results? Foreign exchange affects Coca-Cola because it earns significant revenue and profit outside the United States. Translation converts local results into US dollars, so a weaker local currency can reduce reported revenue and earnings even when local performance is healthy. Transaction exposure can also affect costs or intercompany settlements. I would analyze reported and constant currency results separately, review hedge impacts, and avoid treating currency-driven changes as operational deterioration when evaluating trends or updating forecasts. Make sure to cover translation exposure, transaction exposure, reported versus constant currency growth, hedging, geographic diversification, local pricing, and the effects on revenue, earnings, cash flow, and performance interpretation. Question 7. How would you build a revenue forecast for Coca-Cola? I would begin with a bottom-up forecast by region, category, channel, and major product or customer group. Each line would reflect expected volume, pricing, mix, seasonality, promotional activity, currency assumptions, and known launches or distribution changes. I would compare those outputs with historical relationships and company guidance, then create base, upside, and downside cases. After reviewing the forecast with commercial stakeholders, I would document assumptions so variances can be explained rather than merely observed. In your answer, discuss bottom-up drivers, historical trends, volume, pricing, mix, seasonality, geography, product launches, customer assumptions, scenarios, and validation against management guidance. Question 8. What financial metrics would you monitor for Coca-Cola? I would monitor organic revenue growth, unit case volume, price and mix, gross margin, operating income, free cash flow, and return on invested capital. I would also track working capital efficiency, net debt, leverage, and marketing spending as a percentage of revenue. The key is to view metrics together. Strong revenue growth is less attractive if it comes from unsustainable pricing or causes margin erosion. I would also compare actual results with targets and relevant competitors. Be sure to mention organic revenue growth, unit case volume, gross margin, operating margin, free cash flow, working capital, return on invested capital, leverage, and the quality of earnings. Question 9. How would you explain a gross margin decline at Coca-Cola? I would create a gross margin bridge separating revenue effects from cost effects. Potential causes include unfavorable product or geographic mix, higher sweetener, aluminum, packaging, freight, or manufacturing costs, increased promotions, and foreign exchange. I would then quantify pricing and productivity benefits to determine whether they offset inflation. For Coca-Cola, I would also consider concentrate versus finished product mix and bottling arrangements. Finally, I would assess whether the decline is temporary, forecastable, or evidence of a structural change. While answering, focus on pricing, product mix, commodity costs, packaging, freight, foreign exchange, productivity, promotions, bottling economics, and a bridge separating temporary from structural factors. Question 10. What is free cash flow and why is it important at Coca-Cola? Free cash flow is generally operating cash flow less capital expenditures, representing cash available after maintaining and developing the business. It matters because Coca-Cola uses cash to fund dividends, debt repayment, acquisitions, brand investment, and strategic initiatives. I would reconcile free cash flow to net income by examining working capital movements, depreciation, taxes, and other non-cash items. Strong earnings are valuable, but consistent cash conversion shows whether reported profitability is translating into financial flexibility. In your answer, define free cash flow, explain operating cash flow less capital expenditures, discuss dividends, debt repayment, acquisitions, reinvestment, and differences between accounting earnings and cash generation. Question 11. How would you analyze Coca-Cola's working capital? I would analyze accounts receivable, inventory, accounts payable, and other operating balances using both dollar changes and days-based metrics. I would compare trends with revenue growth, shipment patterns, seasonality, customer terms, and bottler activity. A rise in receivables could reflect growth or weaker collections. Excess inventory could indicate preparation for demand or slower sell-through. I would quantify the cash impact and investigate whether changes represent sustainable efficiency, timing, or operational stress. Make sure to cover receivables, inventory, payables, cash conversion, bottler and customer relationships, seasonality, days metrics, cash impact, and the difference between healthy efficiency and underinvestment. Question 12. Tell me about a time you identified and explained a financial variance. In a university project, actual event spending exceeded the budget by 12%. I reconciled invoices to the forecast, grouped the variance by vendor and category, and found that late attendance changes caused additional catering and transportation costs. I presented a concise bridge to the project lead and recommended volume thresholds, earlier confirmations, and a contingency reserve. The next event finished within 2% of budget. That experience taught me to explain the cause, not just report the unfavorable variance. Be sure to mention the situation, analytical process, data validation, root cause decomposition, stakeholder communication, recommendation, and measurable outcome using a concise star structure. Question 13. How would you evaluate a proposed marketing investment for a Coca-Cola brand? I would evaluate the investment against an incremental baseline rather than total campaign sales. The analysis would estimate additional volume, realized pricing, contribution margin, promotional costs, media spending, retailer support, and potential cannibalization of other Coca-Cola products. I would separate near-term financial return from longer-term brand benefits, then calculate payback or return on investment under several scenarios. I would recommend a pilot with measurable control groups when uncertainty is high, followed by a scale or stop decision. In your answer, discuss incremental revenue, contribution margin, cannibalization, customer support, brand equity, timing, test and learn design, return on investment, and sensitivity to uncertain assumptions. Question 14. How would you use Excel to analyze Coca-Cola's financial performance? I would structure the workbook with separate inputs, calculations, checks, and output tabs. I would use pivot tables and formulas such as SUMIFs or XLOOKUP to analyze performance by region, brand, channel, or period, then create variance bridges and scenario toggles. I would include reconciliation checks, clearly label assumptions, and avoid hardcoding where possible. The final output should be simple enough for management to understand while retaining enough detail for review and auditability. While answering, focus on data cleanliness, pivot tables, SUMIFs, XLOOKUP, variance bridges, scenario controls, error checks, sensitivity analysis, documentation, and presenting outputs clearly for decision makers. Question 15. How would you approach a budget versus actual review? I would first prioritize material variances and confirm that actuals and budget use consistent definitions and periods. Then I would decompose each variance into volume, price, mix, timing, currency, rate, and expense driver effects. I would distinguish controllable items from external factors, speak with responsible business partners, and document the root cause. The review should finish with an updated outlook and actions, such as changing spend, revising assumptions, or addressing an operational issue. Make sure to cover materiality, favorable and unfavorable variances, volume price mix analysis, timing, controllable versus uncontrollable items, root causes, forecast updates, and recommended actions. Question 16. What is return on invested capital, and how could Coca-Cola improve it? ROIC measures after-tax operating profit generated by the capital invested in the business. Coca-Cola can improve it by expanding operating margins through pricing, mix, productivity, and disciplined marketing, while also improving asset efficiency and avoiding low-return investments. Portfolio decisions, bottling economics, working capital, and capital expenditures matter as well. I would not pursue margin improvement at the expense of brand health. The strongest recommendation improves returns while supporting durable volume and cash generation. In your answer, define ROIC, explain operating profit after tax and invested capital, discuss margins and asset efficiency, and connect improvements to pricing, productivity, portfolio choices, and capital discipline. Question 17. How would higher commodity costs affect Coca-Cola's forecast? I would identify the exposed commodities, estimate consumption volumes, and calculate the change in cost per unit under updated market assumptions. Then I would model the effects on gross margin, operating income, and cash flow, considering hedges, inventory timing, productivity savings, and potential pricing actions. I would create base and downside cases because not all costs can be passed through immediately. The final forecast should clearly separate secured protection from open exposure and explain management actions. Be sure to mention key inputs, cost per unit assumptions, gross margin sensitivity, pricing response, hedging, productivity, timing, scenarios, and communication of risks to senior stakeholders. Question 18. How would you assess an acquisition or strategic investment for Coca-Cola? I would assess strategic fit first, including category growth, consumer relevance, distribution opportunities, and portfolio overlap. Financially, I would forecast standalone performance, synergies, integration costs, capital needs, and cash flows, then evaluate valuation, payback, and returns under multiple scenarios. I would also examine execution, regulatory, and cannibalization risks. A compelling investment should enhance Coca-Cola's long-term capabilities, not merely add revenue, and the recommendation should state the assumptions that drive value creation. In your answer, discuss strategic fit, market growth, synergies, valuation, integration risk, returns, funding, scenario analysis, and whether the investment strengthens the broader beverage portfolio. Question 19. Describe a time you had to communicate complex financial information to a non-finance audience. During an internship, I explained a forecast shortfall to a sales team unfamiliar with finance terminology. Instead of presenting a long spreadsheet, I used a one-page bridge showing volume, pricing, mix, and promotion effects, then translated each driver into a commercial action. I asked questions to confirm the operational explanation and revised the forecast with their input. The discussion produced a shared action plan. I learned that effective finance communication connects numbers to decisions and ownership. While answering, focus on simplifying technical analysis, tailoring the message to the audience, using visual summaries, highlighting business implications, checking understanding, and preserving accuracy. Question 20. If Coca-Cola's revenue forecast missed target but profit exceeded plan, how would you investigate? I would first reconcile the revenue and profit variances by segment, product, and period. Profit could exceed plan because of stronger pricing or mix, lower commodity costs, reduced marketing, favorable currency, delayed expenses, or one-time items despite weaker volume. I would separate recurring drivers from timing and accounting effects, then evaluate cash flow and customer demand. The conclusion should explain whether performance is healthy and sustainable or whether the forecast masks a future revenue or investment risk. Make sure to cover volume, price and mix, gross margin, operating expenses, timing, currency, one-time items, sustainability, cash flow, and whether the result changes the full-year outlook. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.